Okay, well, I'm Mark McClurg and I'm with Real Estate Mortgage Network. I've been doing this a long time, so I'm going to go through this fairly quickly because I know you're all on a time schedule, especially if you have to clock in and out these days. So we're going to go through this fairly quickly. Your handout is pretty comprehensive, has a lot of answers to a lot of questions, and I'm certainly available for any additional questions you may have. Okay, so just to get started here, are all of you first-time home buyers? First time through this? Okay. All of them? Okay. Okay, very good. The important things when you're getting a mortgage, okay, mortgages are a lot more difficult now to get than they were, 5, 6, 7 years ago, okay? They're pretty much about the same as they were back in the early 90s when I first started in the business, so it's not a big shift as far as that's concerned, but then we got a little bit loose as far as lending guidelines. Things got a little crazy. We had a mortgage meltdown, we had a real estate crisis, and they kind of tightened things up a little bit. So the important things you need to be concerned about are credit, obviously, your income and employment stability. Funds to close are certainly something concerned, and reserves are money that you have left over after you've paid the down payment and closing costs associated with purchasing your home, and then the home that you select, okay, as far as the collateral for the loan itself. We just nobody just lends on anything these days, so the collateral is important as far as the quality of the house and also the value of the home. Get into credit just a little bit. They have what they call FICO scores. FICO stands for Fair Isaac Corporation, and they created the credit score model, I should say. All three of the bureaus, Equifax, Experian, and TransUnion, all use the same model, although they call it something a little different. They got minor modifications to it. Experian uses the Fair Isaac model itself. TransUnion uses what they call Classic, and Equifax uses what they call Deacon. So you may hear those terms, from various people when you're applying for credit, what type of score model they used. Okay. And then FICO expansion scores, they're not really used too much in our industry quite yet. They may be in the near future. Those are non-traditional accounts such as utilities, rent-to-own companies, cell phone, cable TV, things like that, that are put into a credit report and scored. Okay, so not widely used right now, but certainly something we may see in the future. What's excluded from the score is anything race, religion, national origin, sex, sexual orientation, marital status, age, all that type of thing. Your occupation, where you live doesn't go into the scoring model at all. Interest rates on accounts don't count, so if you're paying 28, 30% on a credit card, that has no impact on scores. Or if you have high rate car loans and things like that. Credit qualification, or how your score is used by others, okay, it's used for credit qualification, quite honestly, for mortgages, auto loans, credit cards. It's also used for rent, employment. It can be a separator between whether or not you get that promotion or whether you don't. Insurance is a big thing nowadays. They're rating people on score as far as insurance is concerned, so the higher the lower your score, the higher your insurance premiums will be, which I think is a little bit ridiculous, but that's what they're doing. The credit score and optimization screen here shows you kind of what goes into the score. About 35% of the score is your payment history itself, whether you make your payments on time. 30% is the amounts that you owe. Okay, now not necessarily on car loans or mortgages or things like, or student loans or installment type loans, but more on revolving credit card loans. If you have a revolving credit card that has a $1,000 balance, let's say, and you're constantly have it maxed out $950 or $1,000 on the credit card, that will negatively impact your score. The ideal is to have a couple of credit cards, okay, but to have the balances related to the credit limit, okay, at 30% or less of the available credit limit. So if you have a $1,000 credit card, you really should keep that balance at $300 or less to optimize your score. 15% of your score is the length of your credit history. Okay, whether or not you just established credit, or whether you've got a 20-year history of credit, or whatever the case may be, that will affect about 15% of the scoring model. 10% is new credit. Okay, so we don't necessarily want you going out and applying for new credit unless it's necessary to optimize your score because you have no credit or have nothing reporting to the Bureau. Then we have to do something like that. But if you've got a credit profile, it's not a good idea to go out and establish new credit unless it's necessary to optimize your score. And then 10% is the types of credits you have. Now, mortgages and car loans are fine. Okay, that's fine. But then when we get into department store cards, they're kind of a negative. When you get into finance companies like Wells Fargo Finance or Spring Leaf Financial or some of those higher risk, higher rate type finance company things, then they do have a negative impact on your score. Okay? Annualcreditreport.com is a site that was created by the three bureaus, okay, for you to get access to your credit report one time per year. Okay, it's free. Okay, you can go to annualcreditreport.com. You have to go in separately for each bureau that you want to select, but you can get your score once a year from each one of the bureaus. What I recommend people doing that are just getting started is to do that annual credit report. The scores are going to cost you extra money. You don't need the scores. I can kind of tell you what your score is going to be within 50 points of just looking at it versus you paying the extra for the score. The scores that you get are consumer scores anyway, so they don't reflect a mortgage or they don't reflect a car loan. So what you're going to get is what they call a consumer score, which is the raw score. Okay, mortgages and auto loans and things like that, then they have what they call a risk layer that goes on top of that and creates a different score for the type of credit that you're applying for. So the scores that you get from annualcreditreport.com really have no bearing in what we're trying to do here. So I'd recommend everybody go to annualcreditreport.com, pull your credit scores, or pull your credit reports rather, okay, without the score, and just see what things are reporting, okay? Go through a line item by line item, preferably with a professional like myself or someone else to kind of lead you through it because they're not very easy to read, okay? So we can kind of go through it and tell you where you're at, okay? Once you've done that, then after a year passes, then to monitor your credit, then you can order one of the 3 credit reports every 4 months and be able to monitor your credit that way and keep people from, watch out for identity theft or things that may show up on your credit profile that don't belong there. Okay, so it's important to know where you are. Okay, go ahead.
It's my understanding that even though there are 3 credit
bureaus,
okay, that not all of them have the same information.
That's exactly right.
That it varies.
Yeah, that's why it's important to pull all 3 of them initially, so we know what's reporting to who. Because every time somebody reports to one of the credit bureaus, there's a fee attached to that. So not everybody reports to all 3. They may report to 1, they may report to 2, or they may report to all 3. Okay, mortgages tend to report to all 3, okay, because it's the most important credit line item that you'll have. Okay, but then when you get into credit cards and things like that, Sears only reports to Equifax, for instance. Okay, so they only report certain things to certain bureaus, so it'll be different one way or the other. And sometimes the scores will be 50 or 60 points different between one or the other, just depending on when it was reported and what's been reported. Okay, we use the middle of the 3 scores, okay, for mortgage qualification. Okay, so if you have a 720 on one and a 702 on another one and a 696 on another one, we're going to use the 702 as the qualifying report. Do's and don'ts, okay? Review your credit report with a professional, okay? They're not easy to understand. There's a lot of detail associated with it. They try to give you a little illustration or a little index on what's in there and everything to try to explain it, but they're difficult to understand sometimes, and you really don't know what you're looking for, quite honestly. So we can tell you what's in there, a lot easier, okay? Optimize your credit if you need to pay down the credit cards or you need to establish a new credit line or something like that. Those are things that you need to do right away. Talk to a professional early and develop a plan. Okay, if you're thinking about purchasing a home within the next 12 months, I'd certainly recommend that you talk to somebody soon. Okay, because time also goes into the equation. So if you apply for a credit card today because we need to get your score up or need to create a score, it's going to take 90 to 120 days for that to even start reporting to the credit bureau, and then time is what really causes the score to go up. Okay. Budget for your projected housing expenses. Okay, so if you're currently paying $800 a month in rent, okay, and you've talked to a professional, and the house that you want to buy and things like that is going to be $1,000 a month, and we need to kind of budget for that and understand that you need to start putting that extra $200 into a savings account or whatever, so you're actually paying the payment, through your rent plus the additional into savings each month, so you're not struggling then when you get into the home. Establish an emergency fund. That all the pundits in the financial world talk about emergency funds. Murphy has a way of showing up, okay, in the worst possible situations. So when you have the least amount of money, then the car breaks down. Okay, so it's always nice to have that emergency fund. I recommend $1,000 to get started. Okay, put that in an emergency fund and leave it in a money market account or something, somewhere where it can't be touched to go into a checking account or savings and not easily accessible. Just to sit there in case you need it down the road. Okay, don't change career paths. Okay. The employment history required on a mortgage is a 2-year employment history, hopefully at least in the same line of work, preferably with the same employer. So don't change career paths. Okay. Don't open new credit accounts unless specifically needed. Okay, unless we get together, you've met with a professional, and this is what you need to do. Okay, if you need to open a new credit card account, there's ways of doing that the proper way and the wrong way of doing it as well. Don't deposit funds unrelated to your employment into bank accounts. Every nickel that's in your bank account has to be accounted for. Okay, so you get you let a family member borrow some money and they're paying you back in installments or whatever. Don't deposit that money into your account. Use it as for your everyday living expenses in cash, and leave your bank account alone. Only through the mortgage process is that a concern. Okay, but we look back over a 60-day period of time, and if there's deposits into the account other than employment, then you're going to have to explain those. You're going to have to provide documentation associated with that deposit. Okay, and that's all part of the Patriot Act. They're trying to eliminate money laundering and drug sales and all that type of stuff. So they want everything documented. Okay, don't allow any bills to linger. Okay, when you're in a credit profile or when you're in a credit situation, you don't want things to linger. Okay, so if you get a notice from the hospital that you owe them, $15 for a copay or whatever the case may be, pay it right away. Okay, doctors are the worst. They will send it to the collection company if it's not paid within 30 days. They will send it to the collection company, and that will cause your score to drop sometimes 40, 50, 60 points. Okay, so we don't want that to happen. Address notices immediately. Okay, down payment requirements. Okay, if you're a qualified veteran, there is no down payment required. Okay, certain rural areas, you get out in, not so much in the Denver metropolitan area, but you get a little south or a little north, you may qualify for what they call the USDA loan. Okay. For a no down payment type situation. FHA loans, which about 60% of first-time home buyers will go the FHA route, okay, simply because it's the easiest. It's a government-backed loan, and it's the easiest to qualify for from an employment situation, from a credit situation. Also has very attractive interest rates right now. 3.5% of the sales price is the required down payment for that. So on a $200,000 home, you're looking at a $7,000 down payment. Fannie Mae Home Path properties, those are specific. Those are homes that are owned by Fannie Mae. Okay, Fannie Mae is one of the regulatory agencies in our business, and they own homes that have been repossessed from others. And if you're lucky enough to be able to get one of those homes, then 3% down. Okay, and conventional loans generally require 5% down as a minimum. Okay, those are loans that you can pretty much get anywhere. All the banks, my company, we all offer conventional financing. Those are the ones that are Fannie Mae and Freddie Mac, and you've probably heard those terms before. They're the regulatory agencies for conventional loans. Down payment sources can come from your personal savings, can come from gifts from family members, it can come from retirement accounts, either through a hardship withdrawal or you borrow against some. Okay. Sale of assets, okay, if you have an extra car, you can sell that car and use that money to purchase a home. If you have a lot of gold jewelry, for instance, you can go to one of these places on the corner and sell your gold. Okay, anything like that. You can borrow against an asset. If you have a car that doesn't have a balance on it, you can go to the bank and borrow against that car to use for down payment on a home. And then there's a variety of down payment assistance programs available too. Down payment assistance programs, as we talk about them, there's several programs available. Most of them are geographically based. Okay, different counties and different cities have down payment assistance programs themselves. Adams County has a very nice one. Okay, they'll lend you up to $7,000. There's no repayment of the $7,000. There's no interest that accrues, and it's forgiven over a 10-year period. Douglas County has a similar program. They'll lend you up to $15,000 for down payment and closing cost assistance. The City of Aurora, up to $10,000. Colorado Housing Assistance Corporation, they're the administrator for the City and County of Denver. They're also the administrator for Jefferson County and Arapahoe County. Okay, most of their programs are $10,000 as well towards closing costs and prepaid expenses. Closing costs, prepaid expenses, and down payment, quite honestly. Okay, so they'll lend you up to $10,000. There is a payment on those programs. Okay, over a 30-year term, so the payment's very small. Okay, and then you have the Colorado Housing and Finance Agency, which is better known as CHAFA. You may have heard of that program as well. And we'll get into those in a little bit more detail.
They don't roll those into your mortgage?
No, it's a second mortgage.
It's a second mortgage.
It's a second mortgage. Yeah.
When you say that by where geographically, is that where you want to live or where you live now?
No, where you want to live, where the house is located. Yeah. You do need to be a first-time home buyer for most of the programs. The definition of a first-time home buyer is somebody who has not owned a home in the last 3 years. Okay. CHAFA, well, we'll get into CHAFA here a little bit later, but they do have a program that is not, you're not required to be a first-time home buyer on it. We'll get into that a little later. Okay. Income limitations, most of them have the CHAC program, the City and County of Denver, Jefferson County, Arapahoe County, Adams County, Douglas County, all of them have what are called income limitations. Because the money is coming from the federal government and there's stipulations put on that money that when they get it from the federal government. So 80%, and it's designed for low to moderate income households. So 80% of the median income based on family size. So if you're a family of, well, we'll get into that on the next slide. You must attend a homebuyer education class, okay, designated by the specific program. There are certain programs that you have to go to their particular education. There's others that you can do them online and things like that that qualify for a lot of them. The minimum borrow contribution is 1%. Now, I talked about a $200,000 loan a minute ago where you needed a $7,000 down payment, okay? Well, the minimum borrower contribution is 1% of the sales price, and all of a sudden that $7,000 becomes $2,000, okay? Some of them are minimum of $1,000. So just depending on where you go will determine what the qualifications for that particular program are. But kind of use the 1% as a barometer because that covers most of them. Some require additional property inspections. They wanted to meet certain standards. Okay, I did one in Aurora where they came in with they wanted their inspector to go through and found there were termites in the house. Well, I've never heard of termites in Colorado, but this particular house had termites, so we had to go through a termite remediation program prior to them closing on the loan. These are the income restrictions for most of the programs. For a single person, income cannot exceed $44,450, okay, and up to a person, six-person household where you know, husband and wife and 4 children, okay, $73,650, or an adult who is considered a dependent to your family. Must continue to be owner-occupied. Okay, you cannot turn around and rent these properties. Okay, once you use a down payment assistance program, it must continue to be owner-occupied through the initial term. Adams County for 7 years. Most of them are in that 7, 8, 9-year period. It does establish a second mortgage on the property. Some are interest-bearing and require monthly payments, and others are forgivable over time. Some have no payments and are paid off at maturity. And all household income is considered for qualifications. So if you do have mother or father living with you, they're considered a dependent of yours because of their age or their disability or whatever the case may be, but they receive a Social Security or disability check from the government, that income does have to be considered in that income qualification. Colorado Housing Finance Agency, the CHAFA program, they have much higher income limits. Okay, on a single-family home with a 1 or 2 person household, the income limitation is $71,000. Okay, if you get into the one that's not designated for first-time home buyers, then it goes all the way up to $91,000. So there's a whole lot more flexibility with the CHAFA program. It's because CHAFA is a self-supporting agency. They don't get money from the government. Okay, they get money from private sources or by selling bonds, things like that. So they're a private source, so they're not limited to those government issues. It's available statewide. The programs are programs for non-first-time home buyers. The down payment assistance is limited to 3% of the mortgage amount. So typically, if you do CHAFA, there's still it's still necessary to get some help from the seller, in the form of seller-paid closing costs and prepaid expenses in order for you to get in for that minimum down payment. The down payment assistance is a second mortgage. It is at the same rate as the first mortgage and same term for 30 years. They have unlimited funding because, again, they're not held back by the government. Okay, so they create their own funding, and they have pretty liberal qualification guidelines. Their credit scores are lower, and that type of thing. Okay. Budget for the house payment. Determine your qualifications again with a professional, and determine what you qualify to do. Okay. Your qualifications in your comfort zone may be different. Okay. I may say that you qualify for a $1,500 house payment. Well, you don't want to write a check for $1,500 every month. So most people I find are more conservative, okay, than what the guidelines will allow. Okay. The one problem that we have is if we have a married household and there's 2 incomes coming into the household, but maybe one person's credit won't qualify for the mortgage. Well, we have to limit our qualifications for the one that qualifies. Okay, if we can't use a person's credit, we can't use a person's income. So sometimes we'll run into that issue. Well, we make $4,000 a month. We can make a payment of $1,500, but the one borrower only makes $2,000 a month, so you really only qualify for a $1,000 house payment instead of a $1,500 house payment. Okay. Consider any added expenses. You have utilities and maintenance. When you're a renter, you can just call the landlord and have them fix things. Okay. When you're a homeowner, you have to fix things yourself. Okay, or have them fixed. Trash removal. A lot of times that's included in your rent. It's not included when you own a home. Okay. Make the payment by saving the difference. And I talked about that a little bit. If you're paying $800 in rent right now and your projected house payment's going to be $1,000, then save that extra $200 each month and act like you're making the payment already. Consider the total price of home ownership. Your house payment is referred to a PITI. Okay. PITI stands for property. It stands for principal, interest, taxes, and insurance. And I should put HOA on the end of that because some properties here in Denver have what they call an HOA. That's a homeowners association, and that HOA also goes into the calculation, the qualifying calculation. Utilities, gas, electric, water, sewer, trash removal, cable TV, internet service, all that stuff is now your own. It's not provided by the landlord. Maintenance. And then also, when you're purchasing a new home, you should consider a home warranty. Whether you get the seller to pay for the home warranty or you purchase it yourself, it's cheap insurance and covers that first year, so you don't have any big expenses associated with the property in that first year period of time, where a furnace goes out, or air conditioning, or even the stove and refrigerator. Things like that are all covered under a home warranty.
You have to buy that?
You do have to buy it, yes.
Is it expensive?
No, they run about $400.
A year?
A year, yeah. So, and some of them are renewable, some of them are only good for the first year, some of them are renewable, but surely I'm sure has all the information.
I have more information.
Yeah. There's a local one here called Blue Ribbon. I've used them a couple of times, and then there's several of the real estate companies have have affiliated warranty programs. Purchased a home for all the right reasons. Okay, a lot of people got kind of hoodwinked, you know, just prior to the mortgage crisis because house values were going up so quickly. They went out and you know, bought more house than they should. Okay, as an investment. Okay, well, a house is an investment. There's no doubt about it, but it's an investment over a long period of time. Okay, it's not something that you're going to get rich quick by owning a single-family property. But you buy a house for family safety and security, fixed payment confidence. Okay, right now you've got an article in front of you where rents in Denver are some of the highest, or rent increases in Denver are some of the highest in the country. Generally, what did the article say? 4%, 5%?
Denver is the fourth city in the country that's on top of the list of those.
Yeah. So rents
rentals
are going sky high here. Okay, the average is I think 4 or 5% a year. Okay, versus your fixed, versus when you get into a house. Okay, not saying that you have to go with a fixed rate loan, but when interest rates are under 4%, it's a good idea. Okay, to go with a fixed rate loan, and then you don't have to worry about that payment going up. A lot of people got involved with adjustable rate loans and all kinds of things just prior to the mortgage meltdown, and that caused a lot of the problems when those increases happened and they could no longer afford the house. It allows you to express your lifestyle. Okay, you can paint the walls a different color than white. Okay, you know, you can paint the door a different color. You can do things differently. You can hang things on the wall without worrying about losing your security deposit because you got pinholes in the wall. Okay. Things of that sort. It's yours over time, okay? At the worst case scenario, after 30 years passes, you will own the home free and clear, okay? So whether or not you accelerate the payments to pay it off earlier or whatever the case may be, over time you will own the home, okay? When you rent an apartment or a house, you never own it, okay? You're paying the other guy's mortgage and he owns it probably free and clear and he's just making a boatload of money off of you. A home is an investment, like I said, but it's a long-term investment. It does appreciate over time, regardless of what's happened here in the last 5 or 6 years, where we've seen property values decline, okay? They do appreciate over time, okay? I think the appreciation level here in Denver year over year is 6.1% this year, so, which is a little higher than it probably should be, quite honestly, but it's not going to get back to the 10, 12, 15% appreciation levels that we saw prior to 2007. Mortgage products, okay, you have the FHA loans, the VA, and the RD loans. Those are all government insured, okay? So if for whatever reason you fail to make the payments or whatever the case may be, the government takes possession of the property and the mortgage insurance or funding fees that you pay associated with those loans cover the losses that the agency incurs by reselling the home, okay? Liberal qualification guidelines in most cases, okay? No to low down payment requirements, okay? The VA and the RD loans, the VA and the USDA loans are no down payment required, okay? The FHA loans requires the 3.5% down, but they all allow for the down payment assistance programs. The FHA renovation loans, that's the 203K. You may have heard that term, I don't know. Government's all about numbers, okay? So the 203K is a purchase and renovation program. It allows you to buy that older home and make the cosmetic improvements or the structural improvements or whatever needed, okay, to bring that home up to minimum property standards, okay, or to make the house more to your liking, okay. Very rarely are you going to walk into a house, whether or not it's brand new or 100 years old, or you're going to walk into a house and it's going to be absolutely perfect, okay. So the 203K allows you to take care of those things. You know, you find a house maybe that the people lost and it's been vandalized and somebody pulled the copper out of it, okay, which has happened, okay, many times, okay, right here in Denver. That house is not financeable, okay, because it doesn't have plumbing, okay. So the 203K allows you to buy that house typically for a lot less than what you pay for that house if it did have the copper, and you can get somebody in there to take care of those items, okay. Make the expected major repairs right away. You got a 30-year-old furnace sitting in the basement, okay? Well, it may be time to upgrade. You're going to have to upgrade it probably in the next 2, 3, 4, 5 years anyway. Might as well do it right now, okay? get a high efficiency furnace in there and qualify for some of the energy efficiency programs that are out there. And then also minimize the maintenance costs. Okay, you got something that needs painting, or the brick needs tuck pointing, or whatever the case may be. Those things can all be included right into your loan. Okay, and every $1,000 you borrow is about $4.50. Okay, so it's a lot easier to pay $4.50 than it is to come up with $1,000 down the road where you have to pay for those repairs. Conventional loans, generally, they're lower monthly payments because the mortgage insurance is a little less on the conventional loan. You're putting more money down, quite honestly. Generally, higher down payment requirements, stricter qualification guidelines. Anything less than a 20% down payment requires what they call private mortgage insurance, which is it's on the government loans as well, but it's not private at that point. You're paying it to the government. But private mortgage insurance and what they call PMI, you may have heard that term. And conventional loans pricing on conventional loans is based on the risk that the lender is taking by granting you the loan. Okay, so if you've got a 620 credit score, which for all intents and purposes is the lowest credit score you can have to qualify for a mortgage these days. If you have a 620 credit score, your interest rate is going to be much higher than somebody that has a 740 credit score. Okay, it's also going to be different in the amount of down payment that you have. So if you're putting 5% down versus 20% down, your interest rate's going to be a little higher because the risk associated with that loan is greater. Okay. Items needed for your qualification, very simple. These are the items that I need from every borrower, okay, regardless, okay. And then in addition to these items, based on your individual circumstances, there may be other things needed as well. Okay. Rent to own, fixed payments versus rising rents. We just talked about that. Okay, rents are rising at an average 4 or 5% per year. Interest and taxes become tax deductible when you own a property versus rent is not. You build equity over time. It's an appreciable asset. Okay. Family safety and security, again, you can express your lifestyle. You build community. Okay. When you own a property in a neighborhood, you become friends with your neighbors because you're going to be there a long time. Versus when you live in an apartment building or renting, you typically don't interact with the neighbors nearly as much. Okay. As a homeowner, your voice is louder. Okay, you're more likely to vote. Okay, you're more likely to take an interest in your local community affairs. And when you're a homeowner, your voice is taken a lot more seriously than when you're a renter. Okay, these are some of the links. Okay, and unfortunately, you didn't get this. It's not really a link. You'd have to type this into the address bar, but. These are links to various home sites that are for sale. Okay, if you want to look at some of the homes that the VA owns, for instance, and these are all homes that have been taken, that have been repossessed. Okay, basically from the previous owner. Okay, so VA homes, FHA homes for sale, Home Path homes, Home Steps, which is Freddie Mac's owned homes. Okay. Colorado Assistance Corporation, okay, the Aurora Hope program. They don't really have a website, but you can call them and talk to them if you're interested in living in the city of Aurora. Adams County, Douglas County, and then Colorado Housing Finance or CHAFA. Okay. And if any of you are seriously consider purchasing a home, I do have a special offer for you. You know, the personalized rent to own analysis based on your individual circumstances. Confidential credit review. Okay, we'll go through your credit report either from annualcreditreport.com. If you want me to pull your credit report, I can do that as well. And we can go through that. I can give you ideas on what needs to be fixed or rectified or whatever the case may be. We can do a pre-qualification, create a game plan towards your own home ownership. So if you wouldn't mind, okay, by the little form that you received there on your chair, the one that asks for your number and your email, if you could fill out one of those forms and pass it to Shirley. I can be in touch with you, or all my contact information is available on the next slide. Okay, my office phone, my email, whatever. Please feel free to contact me. There's no cost or obligation for anything that we do. I can meet with you personally. We can talk about it over the phone, whatever you choose, and we can.
Mark, what's the average interest rate going right now?
The average interest rates right now, yeah, they're actually going up right now.
Crap.
Okay, because there's been some positive economic news, which is good on one hand, but it's not so good for mortgage rates. Interest rates right now on an FHA loan are about 3.75%. Okay, on a conventional loan, again, depending on your down payment, credit scores, and things like that, you're looking probably more towards 4% right now, maybe a little less than 4, 3.875 to 4% on a conventional loan. And again, depending on your qualifications.
How are these foreclosures, if you were interested in buying a foreclosed house or something, is it a complicated process?
It is not a complicated process. If it's bank owned, okay, the bank is the seller. Okay, you put your contract offer in, and the bank reviews it. Okay, to determine whether or not they'll accept or reject.
Are they relatively lower than the actual market?
They are typically priced. I would say probably an average 15%, maybe. You know, it depends on what kind of work they've put into it. Some of them now, rather than putting the raw property on the market the way they took it, okay, they'll go in and spruce it up and
the bank will, or
yeah,
you'd have
the bank will
finance that extension to the mortgage to fix it up?
No, the bank will.
Okay.
The bank will do it before they put them on the market.
Okay.
That way they can maximize what they're getting from the property. I will tell you though that I've got a guy right now that's looking in that 120, 135 price range, and he's written, gosh, I think 22 offers now on properties, and always has been outbid. Okay. I had one. It was a HUD property, HUD-owned property owned by FHA, and it was priced at $120,000. That's what the appraisal was, $120,000. He offered $132 on it, and lost it.
Yeah, that's kind of what's happening with the market, isn't
Yeah.
it, right now? Because there's not enough inventory.
It's the lack of inventory is the whole thing, and people are overbidding on houses right and left, and you know, it's a little crazy right now, quite honestly. But you know, anything under $200,000, I mean, you're going to have multiple offers on, but when you're dealing with banks, they're relatively easy to work with. Okay. On the other hand, short sales, okay, are not so easy to work with. Okay. They're still owned by the buyer, by the seller. Okay, but the bank has to approve the sale because they're selling it for less than what's owed to the bank.
Mm-hmm.
So they can take a long time. I had one that, well, it took just a little over 6 months, okay, to get it through. But we did finally get it through, and supposedly the government is encouraging the banks to accelerate that process a little bit. I had another one that they did that was owned by Bank of America. Before they accepted, it was 9 months, okay, and before they accepted it, they had 3 separate appraisals done on the property at varying times, just to make sure that they were, you know, getting the best deal they could, I guess. And so yeah, they finally accepted the offer, but it was 9 months later. So some of them take a long time. Short sales, you know, I don't know what your experience is, Shirley, with short sales, but they can be a hassle. You have to be patient is the bottom line. Okay, and as you're patient, then the markets are changing as far as interest rates and things, and it gets a little frustrating at times. But the banks are relatively easy to work with if they own the property. So, any questions?
I have a question.
Go ahead.
Is it true that the prices on homes have gone up because the interest has gone down?
Not necessarily. The price on homes have gone up because of it's all based on supply and demand. Okay, there's been a greater demand because interest rates are low. Okay, so yes, technically that has had an effect because more people are interested in taking advantage of the low rates. Okay, but now it's an inventory problem. Okay. When something goes up on the market, if it's less than $200,000, it's not there 4 days later.
Wouldn't Monica say it's less than 30 days? It's sold usually less than 30 days?
Yeah. Probably under contract in less than that.
Yeah.
Okay. Sold and closed in 30 days, but probably under contract in less than that. Okay.
They go up and they're gone.
Right.
And it's a very unique time in Denver because there is so little inventory and the interest rates are still low and buyers are coming out and trying to get what they could. So it's good for the seller and because they're not going to have to sit on their house for a long time. And it's good for the buyer because the houses haven't escalated to the point that it's unreasonable. And so yeah, it's really a good time to do both.
So would you, if somebody came to you and they're renting right now and they want to stay within that, let's say for example, $800 a month for, I don't even know if rent is that cheap anymore, but if they wanted to stay in that 800 bracket to get into a home, would you help them do that analysis?
Oh, absolutely. Yeah.
Okay.
Yeah. Yeah, that's what the rent versus own analysis is all about, taking what you're currently paying in rent, showing you the tax advantages of owning a home versus renting a
That's
home,
true,
because
too.
they are significant. So, you know, somebody who's paying $800 in rent could probably afford and have, you know, the same housing expense after taxes and all that of you know, an $1,100 house payment, okay? And nothing changed financially for them, okay? Because of the tax advantages.
And then
Okay,
even the
so
equity
you go
that you're
with-
building up to, and if you wanted to eventually go into a, because that's what the last lunch and learn was all about. If you wanted to go to a bigger home.
Right.
And you wanted your payment to stay the same because of the interest that you were paying back, what, 6, 7 years ago? And the equity that you get, and putting that on the new house.
Yeah.
It was only a $4 difference.
Right.
To go into a bigger home.
Yeah.
Actually. Yeah.
Yep, exactly. That's what it's all about. I mean, you know, your first home is not going to be your final resting place, generally, okay? It's not, it's different from when our parents were buying houses. My parents stayed in the house for 30 years. They had it paid off, okay? Well, it's different these days, okay? We're more mobile, okay? We want something different, okay? So, you know, maybe it's because the family size has changed. Maybe there's been an addition to the family, either in a parent or a son or daughter. You know, that you need more room or a better school district or whatever, but, you know, you know, things change and we're more mobile. So the average mortgage stays on the book for 7 years. So whether or not it's refinanced or whether or not it's paid off and sold, you know, the average mortgage stays on the books for 7 years now. Versus
Really the time.
people used to pay off their mortgages.
And I,
Thank you.
I just want to say that the first place you need to start is with Mark or someone like him, a lender like him, that can tell you just where you stand
Yeah.
with a mortgage and your credit. And then once he says you're good to go, this is, you know, this is what you qualify for, then you would talk to a realtor. And you would have that information for them already. And I could help you with it, or you can go to a realtor of your choice. But that's the sequence of things.
Yeah.